All right, guys. Good morning. It's March 7th, and welcome to my service. My name is KT, also known as Cornick Trades. I just want to say thanks for supporting me, and I am excited to teach you guys basically how I can read this market and the simplicity behind how I am able to draw my boxes and why price action is more powerful than using 20 indicators on a chart. So if you guys read through my educational content tab, I had a section that was in Word format form where I basically explain these setups right here. These four are basically how I make my money. And if you think about it, in terms of supply and demand and just why the market moves, I mean, the market either moves up or down for one of two reasons, and it moves sideways for one of two reasons. You get movement in the market because you have an imbalance in price. So what that means is that you basically have more buyers and sellers if the market's going to go up, and if the market's selling off, you obviously have an excess amount of supply and not enough demand to support bids. And if the market is chopping sideways, that means you have price in agreement, like equilibrium. So basically, you have a lot of liquidity there, and basically price is going to stay in agreement until there is an imbalance created. So until there are more buyers and sellers, or until there are more sellers and buyers. So let's jump into it, all right? So these four are the main structures that I look for. First, starting on the left side, we have a rally base rally. This setup right here forms in uptrends in bullish markets. And the idea here is you want to get long on a retracement back to demand. So what this means is that you have the market going up and up and up. You know the market's going to go up, it's going to pull back. And then what you want to do is you want to get long on a retracement to demand. What this doji right here represents, the base, this is called a rally base rally. The demand resides in this basing candle right here. Let me turn this yellow. Okay, so that's where the demand resides, because if you guys think about it, the market rallied, okay? And then it paused for a second, okay? So the market has accumulation and distribution phases. So the market was able to rally, and it paused for a little bit, and then it was able to rally again, okay? So what that tells me is that you have accumulation at this base right here. Because remember what I said, market only moves up or down because demand over supply, or supply over demand. So at this base right here, I know, judging by candle structure and on the higher time frames, that this is a high probable area to get long at, because you basically have price took off at this basing level because there was too much demand. Okay, so what happens is that price basically moved up too fast for them to fill all their buy orders, because it was an illiquid area, which is what caused the big green candle. So basically, what I do is I draw my level like this, okay? So at the basing candle, I take the open of the bearish candle. So I take this open right here. So I take the open of the red candle, and I take my line, and I draw a box from the open to the lows. Okay, so this is basically my setup right here. So I take it from the open of this bearish candle, and I draw it to the lows. And my plan is basically the market's going to move up, and I will be patient, and I will wait for it to pull down for liquidity reasons. I'll wait for it to get yanked down back into demand, because the market is a game of liquidity. It's going to go to where the orders are. And this is a very high probable trade because of the setup. And if it's obviously, if you find the setup on the daily chart, it's very possible, and I will show you guys on Snap one example of this setup working very well. So I would take this fresh level, and I would anticipate the market to pop out because of the pent-up demand that resulted in the formation of this rally-based rally imbalance. So again, I take the open of the bearish candle prior to the rally in price. So here's the open, and I just take my box to the open. It's very subjective, you know. Sometimes this candle can be a green candle, but basically dojis are very strong candles patterns to pay attention for, because when you see this sort of rally-based rally structure, the demand resides right here. So I take the open, take it here, and I extend it out to the lows, and my stop loss would probably be a little bit below the wick low here, maybe somewhere here. You know, again, it's all up to your risk, but that's basically where my stop would be. So that's a rally-based rally candle structure right here. And let me show you guys an example. Okay, so again, this works in all time frames, commodities, you know, futures, equities, you name it. It basically is an analysis of price, and the theory behind it is that price only moves for one reason. So if you get these sort of candle structures to form, it's very powerful because the market only moves for one of two reasons. Okay, so what you guys just learned right there, look at what I found right here. Okay, you get a rally, and then you get this base right here, and then you get another rally. You get a rally, base, and then you get like another rally upwards. So in this instance, remember, you have to always look left. You know, look left and then trade the white space to the right. So here I would put my horizontal ray at the open of this basing candle right here. So it would go right there at the open of, let's call it 13 bucks. And then so that's my proximal line, and the distal line would go to the wick lows. Sorry, it would go to right there. And then I would just simply zoom out, and I would draw my box here. And this is my demand zone right here, okay? And it's fresh. Remember, it was fresh until the market pulled into it. So you get all this price action here. You know, market moves up, chops around, and then you get the sell-off back into demand for liquidity reasons. Remember, market sells back off, sells, and then look at what happens, guys. It gets pulled right into demand, precisely in this level that I mentioned right here, and you get a huge rally. Why? Because the market got overextended from 13 all the way up to 1840, and there's just no demand up there. And judging by this candle structure and just how the candles are formed in this level right here, I could tell you that there was a lot of pent-up demand, and this is a very powerful candle structure. If you see this on a daily or weekly or 4-hour chart, fresh levels are very, very, very high probable setups. So look what happens here. You get the sell-off, and look what happens. The wicks represent like an effort to sell or to pick up orders, all right? So if we know that, judging by my analysis right there, that this is a high probable level based on the candle structure, the market comes into demand right here, picks up those buy orders that did not get filled here. What do I mean by that? At this level right here, where it formed that rally-based rally. Let me just so you guys can see for visual purposes. Rally, base. One second. Rally, base, rally. Okay. All right. So right at that basing candle, where this red doji is right here, rally-based rally. That's where the demand resides. Look at how fast price left that level. You see that? It rallied, paused, and it exploded up. So that tells me that you had a surplus of buy orders waiting right here at this zone because price took off too fast for the institutions and for the big boys to fill their buy orders. So what happens is you get the market to move up, and then you get manipulation lower back into the demand zone. And the orders that did not fill originally when that imbalance was created, those buy orders hit the market right here when the market sells off at that price point. So the market sells off, and look at what happens right from that level. You get a huge rally from that rally-based rally demand zone.